Hey folks, welcome you all to a new video. So let's continue our discussion in this chapter, basic concepts. In that part A, we are in time value of money. So let me just recap whatever we have done, whatever we have covered in the previous session. So in the previous session, we saw that future value is equal to present value into 1 plus r the whole power n. And of course, if you just take 1 plus r the whole power n to the denominator of the LHS, so you will get present value can be rewritten as future value divided by 1 plus r the whole power n, correct? Or you can also say that present value is equal to future value into 1 by 1 plus r the whole power n. You are just splitting it and you can write, and this 1 by 1 plus r the whole power n is called as what? It is called as the discount factor. Yes, this is all these things we saw in the previous session. And we also saw how to add in case of multiple cash flows. We saw scenarios of multiple cash flows. So multiple cash flows can be broadly classified into two: definite period, that is the period is fixed, it is given, and indefinite period, that is up to perpetuity. In case of definite period, the cash flows can be unequal, the cash flows can be equal. In case of unequal cash flows, yes, so we saw that we can use the present value interest factor table. In case of equal cash flows, it is much more easier. You can use something called as present value interest factor of annuity table. Yes, all of these things we have seen. And on the right side of the chart, in case of indefinite cash flows, that is for indefinite period, in case of perpetuity model, again cash flows can be classified into two: equal cash flows and growth cash flows. Here there is no concept of unequal cash flows. Why? So this itself is an indefinite period, that is the period is not defined, it goes up to infinity. Correct. So here you can't have unequal cash flows. In case of unequal cash flows, they need to mention in which year what is the cash flow generated. So that cannot be mentioned in case of an indefinite period. It goes up to infinity. Correct. So in case of indefinite period, there are only two cash flows model, which is equal cash flows and cash flows that show a trend of growth. Correct. In case of equal cash flows, sum of equal cash flows up to infinity. So what is the formula for that? The present value is nothing but the annual cash flow divided by the discount rate, cash flow divided by R. In case of growing cash flows, so up to perpetuity, the formula for calculating the present value is cash flow at the end of year 1 divided by discount rate minus G. So we saw all the logics for this. We saw how this came and all. Sum of infinite geometric progression series A by 1 minus R. Using that, we derived all this particular formulas and we have arrived at this. So conceptually, we have seen all of this. So this is what we have seen till now in the previous session, right? So now let's proceed further to the most important part, the most important aspect in this particular area called time value of money. So this is the most critical discussion, which is a concept called as IRR, internal rate of return. So in IRR, we will be seeing how to calculate IRR in case of single cash flows and how to calculate IRR in case of multiple unequal cash flows and multiple equal cash flows. We will tread slowly in this area. This is a very, very important area. This is a very important area because it has a lot of impact. It has a lot of connections in the upcoming chapters like cost of capital, your capital budgeting. There are so many chapters which we'll be seeing in this particular subject. This particular concept has a lot of impact. It has a lot of interlinking in many future chapters that we are going to study. Are you clear with this? Yes. So this is the main reason why I have included this IRR as a part of time value of money concept itself, because IRR calculation, we will be using it in multiple other chapters. Those chapters will have their own complexities. There again, if I teach you IRR and then also the complexities that is covered in that chapter, it will dilute the discussion. That's why first, right now, we will spend all the time we will understand what is this concept of IRR, how to calculate that, and all of these things. We will see everything in detail, so that wherever, in whichever chapter during the course of this subject, financial management, IRR comes in, you will have a crystal clear clarity and complete confidence over those particular questions. Are you clear with this? Yes. So first, let us get into a concept called as IRR hyphen single cash flows. IRR hyphen single cash flows. So now IRR stands for internal rate of return. So IRR stands for what? Internal rate of return. It is the discount rate at which the net present value, that is popularly called as NPV. It is the discount rate at which NPV is equal to 0. Fine. Sir, what do you mean by this, sir? Sir, what is NPV and all? Slowly, I will just introduce you to this. Don't worry about it. We are yet to see all of them. Okay. So, what is IRR? IRR stands for internal rate of return, and internal rate of return is nothing but the discount rate that makes my NPV equal to 0. We will just slowly get started with this particular area. Slowly, we are entering into financial management. Right now. Till now, all this concept of time value of money, what we have seen, we have been playing around with 4 figures. What are the 4 figures? We've been playing around with 4 figures. The future value, present value, R, which is the rate, and N, which is the period. Correct? Yes. So, when the future value, present value, and N is given, when 3 data is given, that is future value, present value, and the period is given, calculating the rate is called as IRR. Are you clear with this? This is nothing but, you can think of it as of now, you can see this as a missing figure. So we need 4 figures. We have been playing around with 4 figures in our time value of money concepts. When 3 figures are given, calculating R is called as your IRR. So calculating R is nothing but IRR here. Are you clear with this? So when the 3 figures are given, calculating R is called as IRR. Let me just take a small example to explain this particular concept. Let us say the following data is given. Future value is equal to, let us say future value at the end of year 1 is equal to 110, or you can say cash flow at the end of year 1 is equal to 110, any which ways. Then present value is equal to 100, that is cash flow at T0, present date is going to be 100. Period is given as 1 year, calculate R. So they have given future value, they have given present value, and they have given N, that is the period also. You need to calculate R. Very simple, isn't it? Yes, we know this formula. Present value is equal to future value divided by 1 plus R the whole power N. Correct or not? Yes. So what is, you just populate the figures here. Present value is how much? 100. Yes, future value, this is equal to, future value is how much? 110 divided by 1 plus R. What is R? That's what we need to find out. The whole power 1, N is equal to 1. Correct or not? So we have the future value, we have populated that figure. We have the present value, we have populated that figure. We have the period N that we have populated. R alone we need to calculate. Correct or not? This is like a missing figure. Yes, so what you will do, yes, you can just cross multiply this. So can I say 100 into 1 plus R is equal to 110? Yes, so this 1 plus R, the whole power 1 is nothing but 1 plus R. So you take this from the denominator of the right hand side and push it to the left hand side, cross multiplication. So 100 into 1 plus R is equal to 110. Yes, or this is nothing but, again you push this 100 to the denominator of the RHS. Can I say 1 plus R is equal to 100 divided by 110? So this 110 comes to the denominator, or 1 plus R is equal to 1.1. Correct? Or R is equal to, take this 1 to the right hand side, 1.1 minus 1, R is equal to 0.10, or you can say R is equal to 10%. Or basically in this particular equation, if you fill in the 3 figures, you will get one more, the balancing figure, which is R. Correct or not? That is calculation of IRR. So that's all, sir, calculation of IRR. Here IRR was very simple to calculate because it was a single cash flow. So what happened here? There was only one cash flow. No, there was only one cash flow, 110. There was only one future value here. It was very simple. Slowly we will get into multiple cash flows model. That is where the subject is going to be interesting. Are you clear with this? So basically right now what we have seen in IRR for a single cash flow model, how do you calculate that? Very simple. You just populate that formula for your present value and future value. That particular formula, present value is equal to future value divided by 1 plus R the whole power N. Present value is given, future value is given, and N, the period, is also given. Calculating the R in this case is called as IRR. Clear? For the time being, you just understand this. In a few minutes from now, as we enter into calculation of IRR, when there is multiple cash flows, you will completely understand the big picture of it. Why are we calculating? All of that you will understand. Are you clear with this? Yes. Now, let's move to the next concept. Let's move to the next concept, which is IRR in case of multiple unequal cash flows. IRR in case of multiple unequal cash flows. IRR in case of multiple unequal cash flows. Right? Fine. Now, you just patiently listen to this. Okay. So all this working, whatever I'm writing down here will be provided to you. So don't worry about it. Right. Now, let us just take an example. I am just taking an example. Then I will explain why I am giving this example. Everything I will just give. So what is the concept that we are studying? IRR in case of multiple unequal cash flows. Okay, fine. So first, let us take this example. So I have given year and the cash flows pertaining to the respective year. Year 0, the cash flow is minus 10,000, meaning what? There is an outflow. Then year 1, there is a cash flow of positive 1,000, that is an inflow. Year 2, inflow of 1,000. Year 3, inflow of 2,000. Year 4, inflow of 10,000. This is the data given in the question. What we should do? Calculate the rate. Now, first, let's not enter into IRR. Before that, first, sir, why have you given it like this? There is an outflow here and then followed by inflow and all. Why have you given it like this? Why have you given it like this? First of all, understand, this is where we are entering into we are slowly entering into financial management. Always remember, in every complete financial transaction, if you take a financial transaction as a whole, in every complete financial transaction, there will be both cash inflow as well as cash outflow. I repeat, in a complete financial transaction, there will be both cash inflow as well as cash outflow. Sir, can you give an example? Yes, I will give an example. Let us say you want to open a fixed deposit with a bank. Okay, so you are opening a fixed deposit with a bank. What will you do? First, what will you do? Initially, today, T0, you will give the money to the bank. Let's say you want to invest 1 lakh rupees with the bank, right? First, you will give 1 lakh rupees to the bank. You are opening the FD for a period of 5 years. Just an example. So today you will give 1 lakh rupees to the bank. Yes, from your viewpoint as a FD holder, for you, from your viewpoint, it is an outflow, correct? Now, every year for the next 5 years, you will be receiving what? Interest, and at the end of the 5th year, they will also repay back the principal amount that you invested, correct? From your viewpoint as a fixed deposit holder, if you see, initially there was an outflow, you paid the money to the bank, correct? It's not an expense. I'm not talking about an expense. I'm saying outflow. Cash outflow was there, followed by a series of inflow. For the next 5 years, you will be receiving interest, and at the end of 5th year, you will also be receiving what? Your original amount invested, principal amount. Correct or not? Yes. So if you see from your perspective as a fixed deposit holder, there was an outflow followed by a series of inflow. Correct or not? Flip this transaction and look at this from the perspective of the bank. Flip the same transaction and look at this from the perspective of the bank. From the viewpoint of the bank, you are the deposit holder, FD holder. You have paid the money to the bank, correct? Initially, you have parked funds with the bank. From the viewpoint of the bank, initially there is an inflow followed by a series of outflow, correct or not? Yes. So always remember, a complete financial transaction will have both inflows and outflows. From the viewpoint of deposit holder, initially there is a outflow followed by series of inflow, whereas from the viewpoint of the bank, initially there is an inflow followed by a series of outflow. First, you remember this. Till now, what we have done is what? I had given some future data, future cash flows. I had told you, I have given you the R also, discount rate. I taught you how to calculate the present value. That's what I told. Simple mathematics, I told you. That's all, with little concept of finance. Why these cash flows are not comparable, they are not addable assets, all of those things we saw. But right now, we are slowly getting into the technicalities of the subject. Are you clear? We are looking at a complete financial transaction. Always remember, a complete financial transaction will have both inflows as well as outflows in it. Are you clear with this? Yes. So in this case, if you see, maybe this is an example of FD. Initially, there was an outflow of 10,000 followed by series of inflow, followed by series of cash inflows. So you can say this is what cash inflow, correct or not? This is cash inflows, cash inflows. Initially there was what? A cash outflow, correct? Correct. So in fact, this is what we have done also in the previous part. So the previous part, single cash flow model, without knowing, you have done the same thing. If you look at this year, what have we done? 100 rupees is the present value. That is, if you pay 100 rupees to the bank today, if you invest, if you open an FD for 100 rupees today, at the end of year 1, you will get what? 110 rupees, correct or not? So technically speaking, this 100 is what? This is cash outflow, correct? This 100 is what? Cash outflow. This 110 is what? Cash inflow, correct? Correct. Yes, we equated the two and we arrived at the rate. This is what we have done in the previous step also. Basically, this formula is what? We have used the same concept. Are you clear with this? Are you clear with this? Or let me just add one more point. IRR is the rate that equates my cash inflows with my cash outflows. IRR is the rate at which my present value of cash inflow is equal to my present value of cash outflow. Correct or not? Yes, that is what we have done indirectly. This formula, what does it mean? Technically speaking, when the other data is given, you need to calculate R. Correct or not? So, or in other words, IRR is the rate at which my present value of cash inflow is equal to my present value of cash outflow. Agreeing with me or not? This was very simple, since here in this case there was only one cash flow. Only 110 was the single. There was a single cash inflow, correct? When there are series, multiple cash flows, how do you calculate IRR? That's what we are going to do right now. Are you clear? So I just added one more point here and said IRR is the rate at which my present value of cash inflow is equal to my present value of cash outflow. How did we do this? Just by. This is what we could derive from the formula that we had just seen now. Are you clear with this? So here, can I say, so here what we need to do, we need to calculate the rate that equates my present value of cash inflow equal to my present value of cash outflow, correct? Now, first, if you see in this case, what happens? Initially, there was an outflow. Yes, can I say 10,000 is equal to every year's cash flow you take. 1000 divided by 1 plus r the whole power n. Second year cash flow 1000 divided by 1 plus r the power 2. Then the third year cash flow was how much? 2000. 2000 divided by 1 plus r to the power 3. And the fourth year 10,000 divided by 1 plus r to the power 4. So technically what we are saying, R, that is IRR, is the rate that equates my present value of cash outflows with my present value of cash inflow. Correct or not? Yes, we use the same logic. From the known, we are moving slowly to the unknown. Correct? In case of a single cash flow, you were able to appreciate this. Similarly, here, if you see, technically speaking, R is the rate that equates my present value of cash outflow with my present value of cash inflow. Are you clear with this? Are you clear with this? Yes. Are you all clear with this? So, in this case, there was an outflow. Yes, 10,000 rupees was the initial year's outflow. Yes. Yes, this is equal to what? The present value of all my inflows. Are you clear with this? And the rate R is that I need to calculate R. The rate at which my outflow is equal to inflow, or the present value of inflow is equal to outflow, is called as IRR. Now, what we will do is, this is the first cash flow equation. This is the complete cash flow equation. Are you clear with this? So what we are doing is, let us take this 10,000 to the right hand side. So can I say 0 is equal to, so these things will retain. So 10,000 divided by 1 plus r to the power n plus n plus 1 plus r to the power 1 plus 1000 divided by 1 plus r to the power 2 plus 2000 divided by 1 plus r to the power 3 plus 10,000 divided by 1 plus r to the power 4. This is what? This is the present value of cash inflow. then this outflow, this 10,000 goes to the right hand side now. Can I say minus 10,000? So reframing this entire equation, simple mathematics, can I say 0 is equal to the present value of cash inflow minus 10,000, which is present value of cash outflow. Correct or not? So first we framed this cash flow equation. Nothing, I am just taking this 10,000 which is there on the LHS, I am taking it to the RHS. Yes, so if I take it to the RHS, it becomes minus 10,000. Correct or not? Yes, so this becomes minus 10,000. So here it is present value of cash inflow minus present value of cash outflow is equal to 0. Correct or not? Yes. Now when I say present value of cash inflow minus present value of cash outflow, all these things are present value only. Correct or not? Present value of cash inflow minus present value of cash outflow is popularly known as net present value, NPV. So what do you mean by NPV? NPV means stands for net present value. Why is it called as net? Why? What is netting off? You are netting off your present value of inflow with your outflow. This netting off of cash flows is called as net present value. So what do you mean by net present value? The net present value means present value of cash inflow minus present value of cash outflow. So this is why I said earlier, the rate at which my NPV is equal to 0 is called as IRR. I told you earlier. Yes, can you see this? IRR is the discount rate at which my NPV is 0. Are you clear with this? IRR is the rate at which NPV is equal to 0. Are you clear with this? So here, let me just summarize what we have done till now. Number one, I told you that in a complete financial transaction, there will be both inflows as well as outflows. Correct? So initial outflow followed by a series of inflow, or initial inflow followed by series of outflow. This is how any financial transaction will be. And the rate that at which the present value of cash outflow is equal to my present value of cash inflow is called as my IRR. This we saw here. So here, if you see, I invested 100 rupees and I got 110 rupees at the end of year 1, and the rate that equates my present value of outflow with my present value of inflow is called as IRR. Yes, here it was a single cash flow, no problem. But the logic we are taking from there and we are framing one equation. This is called as the cash flow equation. So here I said 10,000, that is the amount I invested initially, is equal to the present value of all the inflows that I receive, and the rate that equates, the rate at which this equation is actually holding valid is called the rate. That particular rate is called as IRR. So first we have framed the cash flow equation. Yes, so now what I did, this 10,000 I took it to the right hand side. So I said here we already have the present value of cash inflows on the right hand side. Yes, minus 10,000, this is present value of cash outflow, is equal to 0. Correct or not? Yes, because everything on the LHS has been taken to the RHS. Correct? And I further said, when you do present value of cash inflow minus present value of cash outflow, this is called as net present value. Why is it called as net present value? Netting means what? You are netting your cash inflow with your cash outflow, but the inflows and outflows cannot be directly netted off. Everything is done in present value terms. Correct or not? We are bringing it into comparable terms. So the present value of cash inflow minus present value of cash outflow is called as NPV, and the rate at which your NPV is equal to 0 is called as IRR. Are you clear with this? So basically right now, what should we do? We should calculate the rate. So this is our equation right now. 1 second. Let me just put this in a green ink. So this is our equation right now. This is the equation we have right now. Correct? So this is the equation we have right now. So now what do we need to do? We should calculate R. Okay, R can be anything, 11%, 12%, 13%, 12.5%, 11.5%, whatever it is. We should calculate R. Okay, so we should calculate that R is the rate that makes this entire equation exactly equal to 0. Correct? So R is the rate that makes this equation, that makes this particular equation 0. R is the rate at which your NPV is equal to 0. Correct or not? Yes. So now, sir, perfect, we understood. How do you calculate R? This is the next question. So you need to calculate R. and we know that R is the rate at which this entire present value of inflow minus 10,000, that is present value of outflow, is exactly equal to 0. Correct? That is the IRR. That rate at which the NPV is equal to 0 is called as IRR. Perfect. Now, sir, how do we calculate IRR? How do we calculate IRR? Now, till now in this world, there has not been a direct formula to compute IRR. There is no direct and a straightforward formula to calculate IRR, which means to calculate IRR, we need to use something called as trial and error method. We need to use something called as trial and error method. So what is trial and error method? So let us say, for example, I'm just giving an example. They are saying 10 is equal to 2 plus x. Yes, 10 is equal to 2 plus x. Of course, here you know, so x is equal to 10 minus 2, which is 8 directly. Suppose you have to use something called as trial and error. Assume there is no subtraction concept and all. So you have to use trial and error method. How will you use? First, you will say x is equal to 1. You will substitute x is equal to 1 here. What will you get? You will get 3 in the right hand side. 3 is not equal to 10. So fine. So next trial you will go. Say x is equal to 2. You will substitute x is equal to 2. How much you get? 4. So now 4 is not equal to 10. So x value cannot be 2 also. Like this, you keep on doing it till the time you arrive. Then you randomly you take x is equal to how much? You take x is equal to 8 and you substitute. 2 plus 8 is 10. Now this is satisfying the equation. So finally you will arrive at the answer saying x is equal to 8 only. Correct or not? This is called as trial and error method. That is, you substitute the x value. You substitute the x value. You keep on substituting it till the time you get the right answer. Are you clear with this? Yes. So this is called as trial and error method. So here what we need to do? Here also what we need to do? First, let R be equal to 10%. Correct? You substitute R is equal to 10%. Do this entire equation. See if the value you are getting it as 0. If it is not 0, once again you say let R is equal to 11%. Try it like that. You should keep on doing. You should keep on doing. Are you clear with this? Yes, of course. There's something called as interpolation, using which you can slightly reduce your workload. You can slightly reduce your workload. What it is, I will tell you. Don't worry about it. So first of all, understand when there is multiple cash flows, if you want to calculate IRR, there is no single formula for you to calculate IRR. When there is no single formula for you to calculate IRR. Are you clear with this? So we need to resort to something called as trial and error method. Now, how do we do it? Very simple. First, yes, let's just make note of this. Note that present NPV, net present value, is nothing but present value of cash inflows minus present value of cash outflow, and the rate at which your present value, net present value is 0 is called as IRR. Now first, using trial and error method, first let us say R is equal to 10%. Sir, why are you taking 10%? It's a random. Randomly we are taking R is equal to 10%. Fine. Now what we should do? Say R is equal to 10%. R is equal to 10%. Yes, substitute this in this equation. Substitute this in this equation. So on the right hand side, substitute wherever R is coming, put it as 10%, substitute, and what we will do, we will pray God that the final answer should be coming to 0. If it comes to 0, then we know that R is equal to 10%. If not, then we know that R is not equal to 10%. Slightly we should change it. Are you clear with this? This is the rule that we need to follow. First, let us say R is equal to 10%. Correct? So when you take R is equal to 10%, this is nothing but what? 1000 into present value interest factor. See, this is nothing but, so the first year cash flow is how much? 1000 into something, that is the present value interest factor of 10% for 1 year, plus the second year cash flow 1000 into present value interest factor of 10% for second year, plus 1000 into present value interest factor of 10% for 3 years, plus 1000 into present value interest factor of 10% for 4 years, correct? Minus 10,000. Yes, this is how, if you substitute R as 10%, this is how your equation will look like. So 1000 into present value interest factor of 10% for 1 year, plus 1000 into present value interest factor of 10% for 2 years, plus 2000 into present value interest factor of 10% for 3 years, and 10,000 into present value interest factor of 10% for 4 years, minus the whole minus 10,000, correct? So the final answer should be equal to 0. If it is not equal to 0, then your R is not 10% is something different. Are you clear with this? So now how do we calculate this? We know how to calculate the present value interest factors, correct? So the first year rate, how do you calculate? 1 divided by 1.1, click is equal to how much you get? 0.909. Then click one more is equal to, you get 0.826. Then click one more is equal to, you get 0.751. Then one more is equal to, you get 0.653, the whole minus 10,000. Correct? So this is nothing but present value of cash inflow. This 10,000 is nothing but present value of cash outflow. Correct? Yes. So now let's calculate this. 10,000 into 0.909. So you get 909 plus 10,000 into 0.826, this 826, plus 2,000 into 0.751, you get how much? It's 1502. Then 10,000 into 0.683, you get how much? This is going to be 6830. So add up all these things. How much you get? You get 10,067. This is the present value of cash inflows minus present value of cash outflow. It's already 10,000. So if you do this, you arrive NPV is equal to how much? Plus 67. Correct? Now, had 10% been your IRR, yes, your NPV would have been equal to 0. Correct or not? If 10% is your IRR, NPV would have been equal to 0. But when you substitute R as 10%, is your NPV equal to 0? No, you are getting the final answer as plus 67, which means IRR is not 10%, it is something different. Are you clear with this? This is the only way in which you can solve it. You cannot solve it directly and all. This is how trial and error method only needs to be followed. Are you clear with this? So now we know that IRR is not equal to 10%. Why? Had IRR been equal to 10%, we would have got the final answer NPV as 0. Correct? So now here NPV is not equal to 0. So IRR is something different. Are you clear with this? Now what do? We should take the next trial. Now we should take higher than 10% or lesser than 10%. You just think and tell me. The next trial that we are going to take, the next trial, should it be higher than 10% or lesser than 10%? Now, if you look at this, think about it logically. If I take my R, as 10%, I am getting a positive NPV of how much? 67. Correct? Now, I want my final NPV to drop. I want my NPV, the final answer, to come down. Correct? Because it is positive 67. It has to come to 0. So, if you want to decrease the final output, what you need to do? You need to increase the denominator. That is, R comes in your denominator. Correct? So, your discount rate should be increased. Or in other words, higher the discount rate, lower will be the present value. Correct or not? Simple mathematics. Because discount rate comes where? In the denominator. If you increase the discount rate, your final present value will come down. Correct or not? Now, if keeping 10 as the discount rate, I get my final present value is how much? 67. So, I need to increase it slightly. I need to increase my discount rate slightly so that my final present value also comes down. Because definitely if you see, I want my NPV to be equal to 0. Correct? But if I keep R as 10%, my NPV is coming to 67. So definitely, I need to increase my discount rate. I need to increase my R value beyond 10%. Only if I increase this, it will come down. The final answer will come down from 67. It will just come down something, because 0 happens. 0 comes less than 67, right or not? Yes. So this is how you need to think. So now, if I keep R as 10%, I get an NPV of positive 67. So the next trial, let us try R is equal to 11%. So let's try R is equal to 11%. Substitute in this equation and let's pray to God that the NPV has to be 0. Correct? Let's pray to God NPV has to be 0. So now what do we do now? The next trial we are taking R is equal to 11%. Why are we taking R as more than 10%? Because if you keep R as 10%, it is giving a positive NPV. I want my NPV to fall down. I want my NPV to fall down by 67. Correct or not? I want my NPV to fall down by 67 because IRR is the rate at which your NPV is equal to 0. If you keep R as 10%, it is showing a positive NPV. So definitely I know that IRR is beyond 10%. It is not less than 10%. Correct or not? So you try the next trial. Let us try it at 11%. Let us try it at 11%. So now what do we have? What do you have right now? So here it is going to be the first year cash flow. So 10,000 into present value interest factor of 11% for the 1 year plus 1000 into present value interest factor of 11% for 1 year plus 1000 into present value interest factor of 11% for 2 years plus 2000 into present value interest factor of 11% 3 years plus 10,000 into present value interest factor of 11% for 4 years minus 10,000. So this is the overall equation. Correct or not? Now let us calculate. Let us just calculate. Find out the present value factors. So now how will you calculate? Very simple. 1 divided by 1.11 is equal to how much? It is coming out to 0.9009. So we can round it off to 0.901. Then click one more is equal to, you get 0.8116 rounded off to 0.812. Then one more is equal to, you get 0.731. Then one more is equal to, you get 0.6587. So rounded off to 0.659. Are you clear with this? Yes, this is the present value of cash inflows minus 10,000 rupees, which is your present value of cash outflow. Let us pray that your final NPV has to be 0. Correct? If your final NPV becomes 0, then our IRR required rate is only 11%. Correct? Fine. So now let us see. So now how much do we get? So 1000 into 0.901, this is going to be 901 plus 1000 into 0.812, this is going to be 812, 2000 into 0.731, this is going to be 1462, and then 10,000 into 6.659, this is going to be 6590. So total this up, this is the present value of all cash inflows, 901 plus 812 plus 1462 plus 6590. So how much you get? 9765. So 9765 is the present value of cash inflow. Yes, minus 10,000, which is going to be a present value of cash outflow. So if you take R as 11%, you get a negative NPV of minus 235. So here also your NPV is not equal to 0. That is, the final output is not equal to 0. But what is IRR? IRR is the rate that makes my NPV equal to 0. If I take R as 10%, it is showing a positive NPV of 67. Correct? If I take R as 11%, it is showing a negative NPV of 235. Correct or not? So to summarize this, let us look at this particular table. If you see, if I take R as 10%, the final output, the answer, the NPV is showing positive 67%. If I take my R as 11%, trial and error only, NPV is showing at minus 235. Now I want my NPV to be 0. Yes. So definitely I know that the required IRR is lying somewhere in between 10% and 11%. Yes or not? Are you able to understand this? If I take R as 10%, it is showing a positive 67 as NPV. If I take R as 11%, it is showing a negative 235 as NPV. My NPV required is 0. It is lying somewhere in between this. So I know that my IRR is somewhere in between 10% and 11%. To this extent, we have found out. Are you clear? We have narrowed down and we have found out to this extent. Are you clear with this? So what is the conclusion we can make? So we can conclude that IRR is lying somewhere in between 10% and 11%. So now, sir, what is the exact IRR? Shall we calculate? Yes, this way of calculating this. So when you have a positive NPV, when you have a rate which shows a positive NPV and another rate that shows a negative NPV, using this, if we can find out the right discount rate, the right rate that makes my NPV is equal to 0, using this method is called as interpolation technique. So what you need to do, take 2 trials. One trial should show a positive NPV. Next trial should show a negative NPV. So I have narrowed down my option by saying that my required rate is lying somewhere in between these 2 rates. Now, how do we find that? That is what we are going to do now. Now, This can be found out using two methods. One is logical method, the other one is formula method. If you understand the logical method, basically you can directly do, you will understand the reason behind the formula. So formula method is nothing but they have given it, whatever logically you understand, they have given it by way of a formula. First, let us see. So now we know for sure that IRR is more than 10% but less than 11%. Correct or not? Yes. So we know that IRR is 10% plus something. Correct? Because it is lying between 10 and 11. We know that it is 10% plus something. How do we calculate that? First, you know that if I increase my discount rate, if I increase my rate from 10% to 11%, correct? For a 1% increase in my rate, how much is the decrease in my NPV? So for a 1% increase in the discount rate, your NPV falls by how much? It was positive 67, it became negative 235. So can I say this is nothing but for a 1% increase in my rate, NPV has what has happened? It has fallen by 67 minus of minus 235. Correct? What was positive 67 has now become negative 235. If you see, this is nothing but 67 plus 235. So can I say for an increase in the rate by 1%, my NPV has fallen by 302 rupees. Are you clear with this? For every 1% increase in the rate, NPV falls by 302 rupees. Correct or not? This is one conclusion you can draw. Yes. Now I know that my NPV is 10% plus something. Correct? So we already have 10%. Yes. Further, we want our NPV to drop only by how much? We want our NPV to drop only by 67. Why? Currently at 10% it is positive 67. I know that I should increase my rate to some proportion so that the fallen NPV is exactly 67 rupees. Only if it is exactly 67 rupees from 10%, if it exactly drops by 67 rupees, my NPV will be 0. Correct or not? At 10%, NPV is positive 67. What should be the extra percentage so that your NPV drops exactly by 67 rupees, making your IRR, making your NPV equal to 0? Are you clear with this? So for a 1% increase in the rate, the drop in NPV is going to be 302 rupees. Now, what should be the increase in the rate over and above 10% so that the drop in NPV should be exactly 67 rupees? This is the calculation that we need to do. First, are you understanding this logic? So if I increase my rate from 10% to 11%, if I increase it by 1%, the NPV falls by how much? 302 rupees. From positive 67, it has gone down to negative 235 rupees. But I want my NPV to fall only by 67 rupees so that it makes it 0. Correct? So for my NPV to fall only by 67 rupees, what should be the change in the rate? This is what we are now calculating. Very simple mathematics, we can do this. Yes, very simple mathematics. Can I say this is nothing but for 1%, the change is how much? 302. How much should be the increase in the rate if you want a fall of how much? 67. This is nothing but 67 into 1 divided by 302. So 1 divided by 302 into 67 rupees. Simple calculation. No? For every 1% change in the rate, the fall in NPV is 302. If the required fall is 67, by how much should your rate be increased? So this is nothing but 1 divided by 302 into 67. So that's what we have done. 1 divided by 302 into 67. So the required change in the rate is going to be 0.2218%. Correct or not? So basically you already have 10%. Beyond 10%, the increase in the rate should have been plus 0.2218. So the required IRR is going to be 10.22 percentage. Are you clear with this? So if you apply 10.22 percentage, maybe if you want, you can check. If you keep R is equal to 10.22 percentage, and if you apply R is equal to 10.22 percentage in this equation, the final NPV you will get it exactly as 0. Are you clear with this? But for some small rounding off, you should be getting it as 0. Are you clear with this? So the rate that makes my NPV equal to 0 is called as IRR. And how did we calculate that? First, we took one trial that had 10 percentage. 10 percentage we took randomly. I will also give you, I will tell you in exam what you should do. How should you pick the trials and all? I will just walk you through, but for the time being, you just understand the concept. So first we took R is equal to 10 percentage. When R is equal to 10 percentage, it was showing a positive NPV of 67. Yes, then we increased the discount rate. Why? Because we wanted our NPV to fall down. So we took the second trial as 11 percentage. NPV was showing somewhere in negative. It was showing negative 235. So with this, we used interpolation technique. What did we see? For 1% increase in R, the NPV has fallen by 302. If I want my NPV to fall by 67 rupees, what should be the change in rate over and above 10 percentage? So it's very simple. 1 divided by 302. So for every 1%, the change is 302 rupees. If I want the change to be 67 rupees, how much should be the change in rate? 1 upon 302 into 67 rupees. If you do this, you will arrive at how much the net increase in rate over and about 10% is going to be how much? 0.2218 percentage. So very simple. It is 10 percentage plus 0.2218 percentage. It's going to be 10.22 percentage. Are you clear? So this is what? This is 1% increase, right? So you can put this is directly in percentage only. For every 1% increase, the change is going to be 302. So this is 1% upon 302 into 67. So whatever you get here as the answer itself is in percentage. It is 0.2218 percentage. So add this directly to the 10 percentage. You will get 10.2218 percentage or approximately 10.22 percentage. Are you clear with this? This is called as interpolation technique to calculate your IRR. So first, interpolation technique has to be done along with trial and error method only. So don't think that there is a direct formula to calculate IRR. No, you need to do trial and error method. Take 2 trials. One trial should have a positive NPV, one trial should have a negative NPV, and based on this, you calculate the interpolation and find out the exact rate that makes your NPV 0. Are you clear with this? Or look, so this is what is the explanation that I have given here. So whatever we have just done right now, I have just given. When the NPV decreases by 302, the rate increases by 1. And when the NPV decreases by 1 rupee, the rate increases by 1 by 302. So this is the logic that I've given. So for every 1 rupee change, the required change in rate is 1 by 302. But I want my NPV to change by 67 rupees. So what should be the required change in the rate? It is 67 into 1 by 302, which is 0.2218 percentage. So 10 plus 0.2218 percentage. So IRR, the desired IRR is going to be 10.2218 percentage. Are you clear with this? The alternative to, sir, I don't want to know all this logically. Can you give me a formula? Yes, this formula you can use directly, but this formula is purely based on the logic we just saw right now. Look at this. IRR is equal to L plus NPVL upon NPVL minus NPVH into H minus L. Sir, what is this? Nothing. L stands for the lower rate. Out of the 2 trials that we took, what was the lower rate? 10 percentage, correct? Plus the whole into, you can just see, plus within bracket NPV at the lower level rate. So if you see, lower level rate is how much? 10 percentage plus NPV at lower level rate is how much? 67 divided by NPV at lower level rate minus NPV at higher rate. NPV at lower rate is what? 67. NPV at higher rate is what? Minus 365, correct? Into the whole into higher rate minus lower rate, 11 percentage minus 10 percentage. This is nothing but whatever we did in common sense. Logically, we did know that only they have done. This is nothing but 10 percentage plus 67 by 302 into 1 percentage. There we did what? 67 into 1 by 302. It's all multiplication and division. It can be rewritten in any format. Correct or not? This is exactly what they have done. So don't think formula method will give a different answer. No. Whatever we did using logical method, that they have presented it as a formula. So if you want to do it in formula method, what is going to be your formula? IRR, how do you calculate? Lower rate plus NPV at lower rate upon LPV at lower rate minus NPV at higher rate, the whole into higher rate minus lower rate. So for a change in 1%, Look, so for a change in 1%, for 1% change in my, or a 1% change in my rate, the change in NPV is 302. How much should be the change in rate if my desired required change in NPV is only 67? Common logic only. This is over and above my 10%, correct or not? So you get the same answer, 10.2218%. Are you clear with this too? So to sum it up, first of all, we saw that any complete financial transaction has both cash inflows as well as cash outflows. The rate that equates the present value of cash inflows with my present value of cash outflows is called as IRR. Or in other words, if you take the outflow to the RHS, so present value of inflow minus present value of outflow is called as NPV. The rate that makes my NPV equal to 0, which is there on the LHS. So the rate at which my NPV is equal to 0 is called as what? The IRR. Now, how do you calculate that? There is no single formula to calculate. There is no formula till date directly to calculate IRR. So what do we do right now? We just need to use trial and error method. So we just let us take R as 10%. We got a positive NPV. So we know that only if you increase the discount rate, your NPV will fall. Correct or not? So we took the next discount rate, which is 11%. At 11%, the NPV was negative, and using this, so we have one rate at which the NPV is positive, one rate at which the NPV is negative. We interpolated the two and found out the exact IRR which lies in between the two. Are you clear with this? And this calculation can be done logically, or if you want, you can also do it using logical, use a formula method. Are you clear with this? Yes. So this is how you compute IRR. Are you clear? Yes. Now IRR stands for what? Basically 10.22% here. So sir, what does IRR stand for, sir? Basically, now if you ask me, look, now let us assume your dad has put this money in the bank. Okay. So initially he has actually invested how much? 10,000. Okay. And over a period of 4 years, these are the cash inflows that he has received. Now, basically IRR, if you calculate, it is the rate that matches your cash inflow with cash outflow. Technically here we saw it is how much? 10.22%. This 10.22% is nothing but it tells you how much return your dad has made. That is, the rate that matches your inflows with your outflow is nothing but the required rate of return. The actual return, how much he has made. Technically speaking, your dad has made a return of how much? 10.2%. So what is your dad's return will be the cost from the viewpoint of company. More details about that we will be seeing in the later on chapters, but just understand this. The rate that matches my inflows with my outflows, technically the rate of return. The rate of return from the viewpoint of the person who is investing the money, from the viewpoint of the person who is giving the money, it is called as what? It is called as cost. Are you clear with this? You go and buy a pack of biscuit and pay 10 rupees. I told you earlier, right? So now from your viewpoint, it's a cost. And from the viewpoint of the shopkeeper, it's an income. Correct or not? Similarly here, if you match all these things, see, these are not directly matchable because the cash flows are spread across multiple periods. They are spread across multiple periods. So if you match the two, you get what? You get the required rate. So now if you ask your father if he has invested, if he has made some investment somewhere, the fund managers, the people who are managing the money, they will say, sir, this year you have made a net overall return of 15% or 10%. How do they calculate this? It is not like once you put the money and once you get the money, single cash flow. No, it happens just like that. In the middle of the day, your dad sends some money. After 5 days, he receives some money. Then after 2-3 months, he receives one more money. So like this, the cash flows will be unequal. The net calculating matching all the inflows and outflows, the rate at which your inflows match with your outflows is called as IRR. Technically, that from the viewpoint of the investor, it is called as the return that he has made. Are you clear with this? Now, there are a few things that you need to understand from an examination perspective. From an examination perspective, there are a few things that you need to understand. First, always take a maximum difference of 5% between the lower rate and the higher rate. Correct? Here we took 10% and 11%. So difference between the two was only how much? 1%. That is fine. But you can take this difference up to 5%. You can take 10% as trial one. The next trial maximum take 15%. Or if you're starting with 15%, the next trial you take 20%, or previous you can take 10%, as the case may be. Are you clear? That is, the difference between your lower rate and higher rate generally should not be beyond 5%. Next, it is advisable to calculate IRR by taking one positive NPV and one negative NPV. Suppose just take it, I'm just giving you an example. Suppose trial 1 you took as 5%, okay, right? It is showing what? It will definitely show. See, if you take your trial as 10%, you're getting what? A positive NPV of 67, correct? Yes. If you decrease your discount rate, obviously your present value will increase, correct? Suppose if you take 5% as the first trial, your NPV will be what? Positive, somewhere it will go, correct? It will be positive. So first trial you are taking 5%, second trial you are taking how much? You are taking, let us say, 10%. Both the alternatives will give what? Both the alternatives will only give you positive NPV. So using this, please don't calculate IRR. That's what we are saying here. So always ensure that when you are taking two trials, yes, we want our NPV to be 0, correct? Take one trial that gets a positive NPV, another trial that gets a negative NPV, so that IRR, your NPV, the required rate of return lies between these two rates. That's when the interpolation technique will properly be adopted. Are you clear with this? So always remember, when you are taking the trials, it is better to take what? It is better to take one rate as first trial, or whatever trial it is. One trial should give a positive NPV, another trial should give a negative NPV, right? Next, higher the discount rate, lower will be the net present value. You know that higher the denominator, lower will be your output, your final result. Correct or not? Yes, we know this. Sir, in exam, what should we do? Sir, randomly, how can we calculate IRR and all? How can we do it in the exam? Now, generally in exam, they will give you the hint. Sir, how will they give us the hint, sir? Now, in this question, suppose this question came for your exam, they will give you the present value tables for 10% and 11% are given. So they will give you the present value factors, the present value table for 1 year, 1, 2, 3, 4, the 4 years. They will give you the present value tables for 10% and 11%. So indirectly, they are dropping you a hint that first trial you take 10%, second trial you take 11%, carry out the interpolation. So if the table is given for the two rates, you obviously know that those two rates should be the two trials. Are you clear with this? This way you can find out. If nothing has been given, which is a rare scenario, if nothing has been given, then what can you do? What can we do, sir? What you do is start with 15% generally. See, here I did 10% and 11% because I know the answer. And here the major thing was to explain the concept. That was the most important objective. But generally, in exam, what you can do, if nothing, no hint has been given, start with 15%. Okay, start with 15%. Now, if you are getting a positive NPV, then the next trial, obviously, if you are getting a positive NPV, what will you do? You will increase the rate. Why? Only then you will try to bring down the NPV. Correct or not? The next trial, you take it as 20%. You know, you can take a maximum of 5% cushion. The difference. So first trial 15%, you take and see. If it is showing a positive NPV, then you need to increase your rate. Take the next trial as 20% and see, definitely it will show a negative NPV. Correct? And now you can interpolate between the two. Suppose at 15% it is showing a negative NPV. So what will you do? You will decrease the discount rate. You will decrease the rate so that your NPV increases. So now at 15%, if it is showing a negative NPV, next trial you take it as 10%. It might show a positive NPV. Based on this, you can interpolate. Are you clear with this? Generally in exams, IRR lie between 10% and 20% only. This is why I'm saying, don't worry. They will give you the hint. What trial you need to take? How will they give the hint? By way of giving you the present value tables itself. If that is not given, start with 15% and based on the positive or the negative NPV that you get at 15%, you can increase or decrease the next trial's rate and you can proceed further in the question. Are you clear with this? Yes. Now, sir, in real life, every time when we need to calculate IRR, sir, always like this only, trial and error method only we need to use, sir, everywhere when we are doing it in real life. That's how the entire world functions. No. There are so many tools, algorithms that are already present. If you just type the cash flows, in a click of a button, in a click of a button. There are so many softwares. It will calculate the IRR and it will show it to you. One simple tool is MS Excel, Microsoft Excel. So there is something called as a IRR calculator. You can use a formula. You can directly get it. Formula in Excel spreadsheet. One single tap of a button, automatically you will get it. Or there are multiple IRR calculators using which in a tap of a button, you can get your IRR. I will show one example right in front of you. See, let us take whatever example we did right now. No, initial year there was an outflow followed by series of inflow. That's what we saw. That's a complete financial transaction. The final answer we got was 10.22%. Correct? We did so many trial 1, trial 2, interpolation, and we finally got the answer. Just see in real life how simple it is. So there's something called as an IRR calculator. There's something called as an IRR calculator. Just Google it. You can just go to any IRR calculator website. Fine. So now let me just make it in rupees. Now, what was the example that we saw? Initial outflow was 10,000, right? So let me just put it as 10,000. It is 10,000 initial outflow. Yes. So how many years are there? 4 years. First year cash inflow is how much? First year cash inflow is 1,000. Yes. Second year cash inflow is 1,000. The third year cash inflow is how much? 2,000. And the fourth year cash inflow is how much? 10,000. See, they themselves have given. Look, initial is what? Investment they have given. So there is an outflow and followed by series of inflows. Correct or not? Very simple. One click of a button. Calculate. See what you get. You get the answer as 10.22%. You get the 10.22%. Are you clear with this? This is what I was telling you. In real life, one click of a button, you get IRR. But for academic purpose, see, you don't get this luxury in your exam hall. In exam hall, it's not a computer-based exam. It's a pen and paper model. So they want to test you on how to calculate the IRR. What we do, we take trial 1, see the NPV, one positive NPV, trial 2, one negative NPV, interpolation technique, and we calculate the final IRR. And IRR is a rate that makes your NPV as positive. NPV is equal to 0. Are you clear with this? But in real life, it all happens in a click of a button. You just need to input the cash flows. Initial outflow followed by series of inflow, or initial inflow followed by a series of outflow. It depends on from which perspective you're looking at it, and obviously you will get IRR. See, this is what we got, right? 10.22%. This is what we got here. This is what we got. Our final answer was how much? Look at this. This is what we got here, 10.2218%. This is exactly what we got. See, that's what even this IRR calculator is showing us. Are you clear with this? Yes. So that's about IRR. That's about IRR. So to put it short, IRR is the rate at which my NPV is equal to 0, and there is no structured formula to calculate IRR as such till date. So we need to do trial and error method, and based on the trials, we need to interpolate it. Are you clear with this? Yes. And of course, you can use either of the two ways of doing it. One is a logical method. The other one is what? The formula approach. Fine. With this, let's move to the next one. IRR in case of multiple equal cash flows. So no new value addition here. The only thing is, if there is an equal cash flow, instead of using your annuity table, so instead of using your present value tables, you can even use your annuity table. Correct or not? You can use your annuity table. Fine. So let us just take this example quickly and finish it off. But remember, what is IRR? IRR is a rate that equates your present value of cash inflow with your present value of cash outflow. Or if you take your inflow, or the whatever it is, if you take the LHS to the RHS, the inflow minus outflow in present value is called as what? Net present value. Or in other words, IRR is the rate that makes my NPV equal to 0. And you take trials and you ensure you should find out the rate that makes your NPV equal to 0. If it is not making it 0, use the interpolation technique between the two trials. Are you clear with this? Now let's move to the next question. So let's move to the next concept, IRR in case of multiple equal cash flows. So this is the data given. Year wise, they have given the cash flows also. So year 0, outflow of 30,000. Year 1, inflow 9,000. Year 2, 3, 4, 5. All the 5 years you get equal cash flows. Calculate the rate. Shall we do it? Yes. Now, first and foremost, what is the first important step? Framing the equation. What is your IRR? IRR is the rate at which my present value of outflow is equal to my present value of inflow. Clear? Yes. So, or in other words, 30,000 is equal to 9,000 divided by 1 plus r to the power n to the power 1 plus 9,000 divided by 1 plus r to the power 2 plus 9,000 divided by 1 plus r to the power 3 plus 9,000 by 1 plus r to the power 4 plus 9,000 by 1 plus r to the power 5. Or in other words, you can take this 30,000 from the LHS to the RHS. Yes, and this present value of cash inflows, can I say this is nothing but 9,000 rupees into present value interest factor of annuity for R percentage for 5 years, correct or not? I don't know what is that R percentage. I need to calculate that R only, correct? Yes, so this is going to be my what? This is going to be my present value of cash inflow minus 30,000, correct? So what was there on the LHS, I brought it to my RHS. So here it is going to be minus 30,000. This minus 30,000 is what? Cash outflow, correct? And I will make my LHS equal to 0. Or in other words, IRR is the rate at which my present value of cash inflow is equal to present value of cash outflow, or in other words, IRR is the rate at which my NPV is equal to 0. Are you clear with this? We have reduced this into this particular equation. Now, what do we take? Let us take R is equal to 15%. Let us take R is equal to 15% and let us just try to calculate this. So, if we take R is equal to 15%, so how will you calculate NPV? So, 9,000 into present value interest factor of annuity of 15% for 5 years minus 13,000, correct? Yes. Now, present value interest factor of annuity for 15% for 5 years. Can we just find it out? Yes, you can find it out using calculator, or you can find out using the table. So we need to go to the annuity table. Present value interest factor annuity table we need to go. So annuity table. So where is your annuity table? 1 second. Yes. So here, 1 second. So you have, this is future value annuity table. Yes, present value interest factor of annuity we have here. Yes, annuity table we've got here. Yes, so this is our annuity table. So what have we got? So this is what? 15% for 5 years we need. So here we have only up to 10%. Let's go to the next page. It's a continuation. Yes, 15% is this column for 5 years. We will just see. So present value interest factor of annuity for 15% 5 years. You go to page number A8, you will find this, right? 15% 5 years. How much is it? 3.352, correct? So multiply this 3.352. So 9,000 into 3.352 minus 30,000. So how much you get? So if you take R as 15%, you get a positive NPV of how much? 160. Conceptually, everything is same. Here, since it is equal cash flow, we have used annuity table. That's all is the difference. Nothing else is the same. Nothing else is different. Okay, everything else is the same. Conceptually, everything else is the same. So if you take R as 15%, you get a positive NPV of 168 rupees. Now what we need to do at 15%, you get positive NPV of 168. Now you want your NPV to be 0, correct? Or in other words, currently your NPV is in positive, you want to bring it down, correct or not? So if you want your NPV to fall down, what you need to do? Increase the denominator, that is increase the rate. So the next trial, I am considering it as 16%. 16%. Fine. So in exam, generally they will give you the hints. How will they give you the hints? They will give you present value interest factor of annuity for 15%, present value interest factor of annuity for 16%. With this itself, you will know the table, the factor for which rates they have given. With this itself, you know that based on these two rates only, interpolation need to be done. Are you clear with this? Yes. So now what we do here? So again, 9,000 into present value interest factor of annuity for 16% for 5 years minus 30,000. So for 16% 5 years, what we need to do? Again, annuity table, we need to do 16% for 5 years. How much is this? 3.274. Correct or not? Yes. So you just write down here 9,000 into 3.274 minus 30,000. So here it is nothing but 29,466 minus 30,000. This is 30,000 minus 30,000. So at 16%, you get a negative NPV. At 16%, you get a negative NPV. So 15% positive NPV, 16% negative NPV. So I want an NPV that should be equal to 0. So clearly my required IRR lies between 15% and 16%. Using the interpolation technique, I can find out my IRR. How do I do that? We can use the formula approach. Formula is nothing but what? Nothing but your logical MAVE only. So the whatever logical method that we saw, the lower rate 15% plus NPV at lower rate upon NPV at lower rate minus NPV at higher rate, the whole into higher rate minus lower rate. So in this case, let us do this logically, no problem at all. So if you see here at 15%, so rate and NPV. rate and NPV. I'm just writing out in rough. At 15 percentage, what is my at 15 percentage, what is going to be our NPV? Positive 168. Yes. At 16 percentage, what is our NPV? Minus 534. Now, what I want to find the rate that makes my NPV equal to 0. Clear? So clearly NPV lies between my IRR lies between 15 percentage to 16 percentage. How do we know that? Because 15 percentage has a positive NPV, 16 percentage has a negative NPV. I want an NPV to be equal to 0. Correct. So it lies in between that. Correct or not? Yes. So very simple. If I increase the rate by 1 percentage, if I increase the rate by 1 percentage, logically you just think and tell me, if I increase the rate from 15 to 16, 1 percentage, if I increase it, my NPV falls by how much? My NPV falls by how much? 168 minus 534. Correct? So 168 minus 534 is plus 534. So how much is that? So it is going to be 702. My NPV falls by 702. But I want my NPV to only fall by how much? I want my NPV to only fall by 168. So if I want my NPV to fall by 168, by how much percentage should I change my rate? Are you clear with this? So this is what they have also done. It is very simple. It is very simple. So for 1 percentage, it is going to be 702. How much is it going to be for 168? So 1 divided by 702 into 168. So 1 percentage divided by 702 into 168. So 1 by 702 into 168. How much is this going to be? So it needs to be increased by 0.2393 percentage over and above our what? Over and above our 15 percentage base. Correct or not? That is what they have also calculated here. Look at this. 15 percentage plus 0.239. So 0.239 percentage should be the increase over and above your 15 percentage. So if you look at this, technically you get your IRR to be 15.239 percentage. So if you now substitute and see R is equal to 15.239 percentage, exactly your NPV will be equal to 0. So basically your NPV is nothing but the rate, your return on investment. If you look at it from an investor's viewpoint. So if your father is investing some money, so once he has invested, followed by series of cash inflows, if you want to net out and find out all these things, see, return on investment formula is there, no? So simple formula, if there is only single cash flow, it is simple formula, but multiple cash flows, how will you find that? The rate that equates my inflows with my outflow is only called as my IRR. That is nothing but the return from the viewpoint of an investor, from the viewpoint of the company, you can call it as a cost. Are you clear with this? So with this we have completed our discussion on IRR. So IRR, single cash flow, very simple. You just need to equate it in that simple formula. Your present value, future value formula, you just had to simply simply plug in the figures. 3 figures are given, R alone you need to find out. Yes, that was very simple, but in case of multiple cash flows, that is where the problem comes in. So how do we do it? First, always remember, in a complete financial transaction, there will be an inflow followed by a series of outflow, or an outflow followed by a series of inflow, or in other words, in a complete financial transaction, there will be both inflows as well as outflows in it. So what do we do right now? So the rate at which my present value of cash outflow is equal to my present value of cash inflow is called as my IRR, or in other words, if you bring the LHS to the RHS, so present value of cash inflow minus present value of cash outflow is called as net present value. The rate that makes my net present value equal to 0 is called as IRR. And how do we do it? Till date, there is no structured direct formula to calculate it. You take 2 trials, ensure that one trial has what? A positive NPV, the other trial has a negative NPV, and using the interpolation technique, you can actually calculate the exact IRR that makes your NPV equal to 0. Are you clear with this logical approach? You can do it, or you can also use the formula method for actually doing this interpolation technique. With this, we have completed the discussion on IRR, and with this, the part A of this chapter, which is part A, which is called as time value of money, we have completed all the concepts in time value of money. So now let's move to the next concept, that is next part of this particular discussion, which is called as valuation of securities. Fine. So this IRR concept that we saw in this particular video, it's a very technical area. So please ensure that you get complete grip and control over it. You get complete grip and control over it, because in the future sessions, multiple areas we will be seeing it then and there. So wherever it is, we will be seeing it. So all the concepts that we have learned in today's session with respect to IRR is what is going to help us in the future chapters also. Clear? Yes. Now let's move to the part B, which is valuation of securities. So we are in the basic concepts chapter. In that, part A was what? Time value of money. We've seen all the time value of money concepts. Now let's move to part B. It's a very simple part. So in this part, what are we going to do? In this segment, we will find the value of the following securities. We will find the value of equity share capital, preference share capital, and debentures capital. Okay, so this is what we are going to do in this particular part. Now sir, in what way our time value of money concept is going to help us in this particular area? I will slowly introduce you. So right now we have actually seen the time value of money concepts. Yes, some mathematical things and all we have seen, and slowly in IRR we saw some financial concept. Yes, so IRR you park it aside. In this discussion IRR will not come, so don't worry about it. Fine. So now let me just give you a small example. So we are going to value the following securities. We are going to value the following securities: equities, preference, and your debentures, right? Now let me just give you an example. Now, I told you in the previous session itself that there is something called as secondary market, the share market in India. There are so many companies like Tata Motors, your ITC, and there is Infosys, many companies. Have you ever imagined why different companies have different share prices? Why different companies have different share prices? Yes, why is there a difference in the share prices of multiple companies? Let me take one more example. Let's say you have a property, a house property in the center, heart of the city. Okay, let's say in Chennai, in a very prime property, in a very prime area, there is a place called Boat Club. Okay, that's the most posh area in Chennai. In Boat Club, you have a particular property, right? And let us say you also have a property in outskirts of Chennai. You have a property somewhere in outskirts of Chennai where the area is not that developed. Now you tell me, which property will be valued more? Which property will have a more value? The property that is there in the heart of the city, or the property that is present in the outskirts of the city? Which property will have more value? Obviously the property that is in the heart of the city, correct or not? That only will have more value. Why is that property getting more value? Because you know that when a property is there in the heart of the city, the rental amount that it generates over the next few years till the time you're holding it, the rental value will be more. So if you are going to buy this property, you know that future years the rental cash receipts, the amount of rental that you will be receiving will be more. That is the future income that you will be receiving out of a particular property. This particular property will be more. So accordingly, you also know that the value of this property is high. Yes, you will be willing to pay more money. Or in other words, the value, the present value of any asset, any property, anything, the present value of an asset depends on the future income generating potential, or in other words, the future cash flow potential of that particular asset. Are you clear with this? Or in other words, the value of a particular asset is nothing but the present value of all the future cash inflows it is going to generate. Are you clear with this? That is why if you see company A, Infosys, and company B, let us take ITC, they both have different cash flow. They both have different share value. Why? Because the dividends that you receive in Infosys will be different from the dividends that you will be receiving in ITC. So the future potential, the future cash flows from these two companies will be different, and accordingly the present value of all the future inflows that you will be receiving from company A will be different from company B, and hence their valuation is also different. Are you clear with this? So till now, whatever is that simple time value of money concepts that we have seen, slowly we will blend it with some valuation of securities. We will blend it with some small finance concepts, and we will see how these instruments are getting valued. Very simple. In case of an equity share, what you will receive? Dividend. Correct? So let us say I'm going to buy an equity share today. Yes, I'm planning to hold it for the next 5 years. After 5 years, I want to sell it in the secondary market. What will be the present value of this equity share? Very, very simple. For the next 5 years, what is going to be the dividend that I will be receiving? And at the end of the 5th year, I will sell it, right? What will be the sale proceeds that I will be generating? The present value of all these cash inflows will be the current market price, or will be the current price of this particular share. Are you clear with this? So slowly see how beautifully we have linked the time value of money concepts with some financial area, financial management. Are you clear with this? So first, let us look at the first one. Let us look at value of equity, constant dividend and definite period. Please take question number 1. Please take question number 1 of your handbook. It's going to be, yes, page number 1. So question number 1. Valuation of equity, definite period, constant dividend. Right. Problem number 1. Mr. Sachin wants to buy shares of MRF Limited. He intends to hold those shares for 6 years, during which he expects to receive an annual dividend of rupees 5 per share. According to his estimation, he can sell these shares after 6 years for rupees 85 per share. His required rate of return is 12%. Calculate the current market price of MRF Limited. Now, this 12% rate and all is given. When the discount rate is given, future value is also given, period is also given. Calculate the present value. Very simple, right? The value of a particular asset, in this case a share, is nothing but the future value of all the cash inflows, the benefits that you are going to receive. In this case, it is very simple. He is planning to hold this for 6 years. There is a finite life. Sir, equity shares, how can it have a finite life? We are talking about this from the viewpoint of an investor, and an investor has a ready secondary market. From his viewpoint, he can sell it after 6 years. Clear or not? Yes, and they have given his required rate of return is 12%. Calculate the present value. That is nothing but the current market price of this particular share. Yes or no? Yes. So this is what we need to find right now. Very, very simple. So for the next 5 years, he is going to receive 5 rupees as dividend. And so for the next 6 years, he is going to receive 5 rupees. And at the end of 6th year, is going to receive 85 rupees of the sale proceeds, which is also an inflow, right? Fine. So very, very simple. So look at this. The current market price, which is also known as P0. P0 means what? Price at 0, year 0. That is the current price. Or it is also known as present value. These are other jargons that can be used. The current market price is nothing but 5 divided by 1.1 plus 1.12 to the power 1 plus 5 divided by 1 plus 0.12 to the power 2 plus 5 divided by 1 plus 0.12 to the power 3 plus 5 divided by 1 plus 0.12 to the power 4 plus 5 divided by 1 plus 0.12 to the power 5 plus 5 divided by 1 plus 0.12 to the power 6 plus 85 divided by 1 plus 0.12 to the power 6. Correct or not? Or this is nothing but the present value of all the dividends plus the present value of sale proceeds, or in other words, the present value of all the cash inflows that I will be receiving is what is the present market value of the particular share. So this is nothing but 5 into present value interest factor of annuity of 12% for 6 years, correct? Plus 85 into present value interest factor. There is no annuity here. Present value interest factor of 12% for 6 years, correct or not? So we can go to the annuity table and find out what is the present value interest factor of annuity for 12% 6 years. Let us go and see, find it out in our annuity table. So we want to do what? Present value interest factor of annuity for 12% for 6 years. So 12% 6 years. So A8, page A8, you have present value interest factor of annuity 12% 6 years. How much is it? 4.111. So you can just substitute it here. 5 into 4.111 plus 85 into, so present value interest factor of 12% for 6 years. Very simple. You can use your calculator. 1 divided by 1.12 is equal to, then once again is equal to, you get finally how much? One more is equal to, you get how much? 6 times you click is equal to, you get how much? You get 0.507. correct or not? You get 0.507. This is the present value interest factor for 12% for 6 years, correct? So you get this, you add the two, the current market price of this particular equity share is going to be 63.65. As simple as that, as simple as that. Are you clear with this? Or in other words, the present value of the market price or the value of something is nothing but the present value of all the future benefits that you expect to receive out of that particular asset. Now, you might have one doubt. Sir, if I go to the share market right now, will this MRF share that we valued, will it be exactly quoting at 63.65? No. See, this is the value that you are willing to pay. Technically speaking, you have found out what is the market value of this particular MRF share in our question, correct? But if you go to the share market, the actual value, the actual price of MRF share could be higher or could be lower than this. This is an advanced level area, but I'm just telling it to you right now. You might be having the doubt. This is the value that we have found, and we have kept it, correct? Now you will see, yes, I am willing to pay, the maximum amount I'm willing to pay to buy one MRF share is 63.65. Suppose in the market, it is quoting at 67 rupees. Then you will say, market has overvalued this MRF share. I will not buy. Suppose in the market it is quoting at only 60 rupees. You will say market has undervalued. I am willing to pay 63.65, but in the market it is only quoting at 60 rupees. It is what? It is being undervalued. Immediately you will go and buy, because the value that you attach is 63.65, but actually in the market they are valued only at 60 rupees. You will go and buy. If the market values at 67 or 70 rupees, you will say it is overvalued. I will not buy. So you will wait for the market price to fall to your level, to fall to your attached market value. Are you clear with this? So basically, this value that we arrive is the correct market value, that the proper present value of the particular share price. Now the actual market price can be more or less than this. So this data, this present value that you found out, will be helpful for you to arrive at a meaningful decision when it comes to purchasing shares in your equity market. Are you clear with this? So this is, technically speaking, the present value of all the future cash inflows that you will be receiving. This is called as a discounted cash flow model. So shares can be valued using multiple models. In case of share markets, technically speaking, in case of share markets, it is valued by forces of demand and supply, but there are certain other forces. Every single force, like COVID came, all the share prices dropped, pharma stocks alone went up. There are multiple other factors, but we cannot consider all those factors. Strictly going by cash flows, we say that the share market value of one MRF share is so much. We go to the market and see. If it is undervalued, fine, I will be ready to buy. Fine. If it is overvalued, I will not buy. I will wait for the market price to fall. Are you clear? It will give you a lot of information. This valuation will give you a lot of information to take the right decision in the market. Are you clear with this? So with this, we have finished this first question. What is the first question? Constant dividend, finite period. So the amount of dividend was also the same every year, and the number of years was also given in the question. Clear? Let's move to question number 2. Valuation of equity share. Definite period but variable dividend. Dividend amount is different. What is it? We will see. Mr. Dhoni wants to buy shares of India Cements Limited. He intends to hold those shares for 6 years, during which he expects to receive dividend of 5 rupees, 3 rupees, 4 rupees, 2 rupees, 9 rupees and 8 rupees per share at the end of each year. So year wise, there is an unequal cash flow, correct? Unequal dividend amount. According to his estimation, he can sell these shares after 6 years for 85 rupees. His required rate of return is 12%. Calculate the current market price of India Cements Limited. Very simple. In the previous question, we use annuity factor, annuity table. In this question, we cannot use annuity table. Why? Unequal cash flows. Some of unequal cash flows, you only need to use the present value interest factor table. Very simple. So the current market price of India Cements is nothing but the present value of all the dividends plus the present value of the sale proceeds, 85. Correct or not? Look at this. Have a look at this. Right? So just look at this. So now the current market price P0. So I will be sharing all these things. This particular whatever I'm writing down here, I will be sharing it with you. So don't worry about it. So now the current market price of the P0 of India Cements is how much? So 5, the first year dividend, 5 by 1.12 to the power 1 plus 3 by 1.12 to the power 2 plus 4 by 1.12 to the power 3 plus 2 by 1.12 to the power 4 plus 9 by 1.12 to the power 5 plus in the 6th year you get the 6th year's dividend of 8 rupees plus in the 6th year itself you also get a sale proceed of 85 rupees, correct? So you can directly add the two. 8 plus 85 divided by 1.12 to the power 6, or if you want you can say 8 divided by 1.12 to the power 6 plus 85 divided by 1.12 to the power 6. Since the denominator is the same, you can add the numerator as such. That's what I have done here. 8 plus 85 divided by 1.12 to the power 6. You can do this, and you know how to calculate the present value interest factor of the respective year. So please take your calculator. 1 divided by 1.12 is equal to, so write down, it is going to be, the first year is going to be 0.893, once again is equal to 0.797, once again is equal to 0.712, once again is equal to 0.636, once again is equal to 0.567, once again is equal to, so that's all, fine, that's all. It is only for 6 years, right? It is only for it's for, yes, it's for 6 years. So this is the 5th year. 6th year it's going to be 0.507. Are you clear with this? So year wise you calculate the present value interest factor, multiply with the respective cash flows, finally you arrive at the rate. What is the value of this? Finally you arrive at the value. The current market price of India Cements is going to be 63.23 rupees. Are you clear with this? So basically the current market price is nothing but P0. The present value of a particular share is nothing but the future value of, the present value of all the future cash inflows that you are expecting to receive out of that particular share. In this case, you receive dividend for 6 years, and at the end of 6th year, you receive the sale proceeds as well. So this was a case of what? Definite period with a variable dividend. And you know that equity shares gives you what? Dividend. In case of an equity share, you get dividend. And who are equity shareholders? Equity shareholders, the real owners of the company. Correct or not? So equity shareholders, you invest in an equity share. Yes, of course, the company will not repay. Yes, you can sell it off in the secondary market and you can get back your money. Are you clear with this? Yes. So now let's move to question number 3. Let's move to question number 3. This is also valuation of equity shares. Indefinite period with a constant dividend. See, we are using all those methods, time value of technique methods that we saw earlier. Look at this. Mr. Hariharan wants to buy shares of ITC Limited. He intends to hold these shares forever. How many period? The period is not given. Perfect. He expects to receive a dividend of 5 rupees per share every year, up to perpetuity. He doesn't know till when he is going to hold. He's going to hold it forever. His required rate of return is 12%. Calculate the current market price of ITC. This is very simple. This is nothing but sum of infinite constant cash flows. So same cash flow you are going to receive up to perpetuity. So what is the formula that we saw? Annual cash flow divided by the discount rate. In this case, every year he is going to receive how much? 5. What is the discount rate? Divided by 0.12 or 12%. Correct or not? As simple as that, So here if you see, this is nothing but the current market price, or P0, is equal to annual cash flow. In this case, it's annual dividend divided by R. So 5 rupees by 0.12. So the share value is nothing but 41.67 rupees. Are you clear with this? Very, very simple. That's about it. See, all the time value of money concepts, how we are applying here in the world of finance. This is how it works. Are you clear with this? Yes, we have seen this model. So guess the next model. It is going to be value of equity, growing dividend up to perpetuity, indefinite period. Look at this. Valuation of equity, indefinite period and a growing dividend model. Indefinite period, infinite period with a growth rate every year. Right. So now let's go to the next question, which is question number 4. Mr. Ram wants to buy shares of A Limited. He wants to buy shares of A Limited. He intends to hold these shares forever. He expects to receive a dividend of rupees 5 per share in the next year, which will grow at the rate of 4% per annum forever. His required rate of return is 12%. calculate the current market price. Current market price is what? P0. That is the present value. Can we calculate? Yes. Now, what is the formula to calculate the present value in case of sum of infinite geometric progression series? This is a geometric progression. Yes. This is a geometric progression series. Yes. Every year there is an annual growth rate. Yes. So, what is the formula to calculate that? What is the formula to calculate that? This is nothing but cash flow. So, the present value is nothing but cash flow at the end of year 1 divided by discount rate minus growth rate. Correct or not? We saw this particular formula, sum of infinite GP series, geometric progression series. Yes, or in other words, they have said here, he expects to receive dividend of 5 rupees at the end of next year. That is what? Cash flow at the end of year 1 is readily available. So, 5 divided by, what is the rate? The discount rate R is equal to 0.12 minus, what is the growth rate? 0.04. Are you clear with this? So 0.12 minus 0.04 is going to be 0.08. 5 divided by 0.08 gives you how much? 62.5. Look at this. That's about it. Very, very simple. So how do you value an equity share that you are planning to hold up to perpetuity, but every year there is a growth in the dividend? Very simple. Cash flow at the end of year 1 divided by your discount rate minus growth rate. 5 divided by 0.12 minus 0.04, that gives you how much? Rupees 62.50. Are you clear with this? Very, very simple. Very, very simple. So we have done the first one. What? Equity shares. So valuing equity shares for all the 4 different varieties of cash flows we have done. Definite period, constant dividend. Definite period, variable dividend. Correct? Yes, unequal cash flows. Then indefinite period, constant dividend. Indefinite period, growing dividend. All the cash flow techniques, we have seen it here. See how practically we have applied it in the world of finance. This is the value addition for this particular segment. Yes, now let's move to the next part. Yes, let's go to valuation of debenture. Now, what do you mean by a debenture? What do you mean by a debenture? Debenture is similar to a loan, correct? Loan in the form of security, right? Fine. Now, the debenture holders, what they will get? They will get something called as an interest, correct or not? Debenture holders will get what? They will get interest as their return, correct? Yes. So debentures are also known as bonds. They are also known as bonds. So bonds and dividends, bonds and debentures are one and the same, right? And interest, the word interest is there, no? Interest is also known as coupon. Always remember, the word interest can also be alternatively called as coupon. Coupon, C-O-U-P-O-N. So interest rate can be called as coupon rate, or interest amount can be called as coupon amount. Are you clear with this? Know this. This is a finance language. Next, interest is always calculated on face value. You know that. If interest you have given 9%, it is on face value only. And if the period is missing in the question, always assume it to be a perpetual or irredeemable debentures. Debentures can also be irredeemable. Are you clear with this? So basically, what do you mean by a debenture? Debenture is a bond, and the return on the debenture from the viewpoint of a debenture holder, an investor, what return he earns? He gets what? He gets something called as an interest. And interest is alternatively called as coupon. Are you clear with this? Yes. Now with this, let us go to question number 7. Question number 7. So please take your handbook. So question number 7. Question number 7. Yes, look at this. Valuation of straight coupon bond for a definite period. What it is, we will just see. A 10,000 rupees par value bond bearing a coupon rate of 14%. Okay, coupon rate means what? Interest rate. Matures after 5 years. The required rate of return on this bond is going to be 13%. Okay, the rate of return that is expected is 13%. Calculate the value of the bond. The redemption value at the end of the year 5 is going to be 1,000. Now, very simple, very simple. Now, you look at this. What happens? We are planning to hold this particular bond from the viewpoint of the investor. You tell me. Yes. So, every year, the investor will be getting how much? 14% on what? 1,000 rupees. So 14% on 1,000 rupees. Every year, the investor will get, the debenture holder will get how much? 140 rupees. For how many years? 5 years. Exactly, he will get 140 rupees every year. So can I say 140 into present value interest factor annuity yes, of what is R given in the question? R is given in the question 13% for how many period? How many years? 5 years. Correct or not? Yes. Plus at the end of year 5, I get how much? 1000 rupees plus 1000 into present value interest factor of 13% 5 years. If I do this, I will get the present value of the bond or the debenture. Correct or not? So what is the present value? Present value of any particular instrument is nothing, or any asset is nothing but the present value of all the future cash flows. So for 5 years, equal cash flows of 140 rupees by way of interest I will get, plus at the end of 5th year I will get 1000 rupees. The present value, the current market price or the value of this particular bond is nothing but 140 into present value interest factor of annuity for 13% 5 years plus 1000 into present value interest factor into 13% for 5 years. Clear with this? Yes. So now look at this. This is what we are just doing. Bond valuation. We are valuing the present value, or B0. B stands for bond, value of bond at year 0, present value. Correct? This is nothing but 140 upon 1.13 to the power 1 plus 140 upon 1.13 to the power 2. Like that, you just keep on doing 140 upon 1.13 to the power 5 plus redemption value 1000 divided by what? 1.13 to the power 5. This is the cash flow equation. Always remember, cash flow equation we need to write. Correct? Look, the rate is given in the question. Sir, how do we know the rate? How do you arrive at the rate? Discount rate, who will say? How to calculate that? That all these things we will be seeing in the upcoming chapters. Are you clear with this? When they give a rate, when they give all the future values, when they give all the future cash flows, and when they give the period, how do you calculate the present value? That's all we are doing right now. Sir, how do you know that in this case 13% you have to calculate as the rate and all? Wait, that rate, the discount rate, how do you arrive at it? We have a separate chapters. We have separate chapters for that talk about it, that we will be seeing later on. For the time being, you just look at this as an independent topic. When rate is given, when all the future cash flows are given, period is given or not given, finite or infinite, in this scenario, how do you calculate the present value? That's all we are doing. How do you know here the rate is 13% and all? Fine. Yes, there are separate chapters which we'll be seeing, advanced level. Slowly, just now we have entered into the subject, we will be seeing it in the upcoming lectures and all that. Are you clear with this? Yes. So in fact, the next chapter itself is about cost of capital. That itself is about calculating the discount rate only. How do you arrive at the discount rate? Discount rate is only your, how do you arrive at it? That is called, the next chapter we will be seeing it. This is nothing but cost of capital. Clear? Remember, this discount rate and your IRR are different. Have that in your mind. We will be seeing it in the later on chapters. These are different. IRR is the rate that makes your NPV equal to 0, or your equates your present value of inflow with your present value of outflow. Here what we are doing, the rate is given in the question. The future values, the future cash flows are also given in the question. Using this, we are calculating what? We are calculating the present value. Fine. Are you clear with this? But when the present value is given, the future values are also given, and when the period is also given, missing figure is the rate. If you want to calculate that, that is called as IRR. But in this case, what is given? Rate is given, the future cash flows are given, period is also given. Calculating the present value, that is not IRR. They have given the rate. Are you clear with this? The rate is given, that is a discount rate. How do you know which is the correct discount rate and all? We will see in a separate chapter called cost of capital. Are you clear with this? The present value of bond is nothing but here 140 into present value interest factor of annuity for 13% 5 years plus 1000 into present value interest factor for 13% 5 year. So let's go to the annuity table and see what is the present value interest factor of annuity for 13% 5 years. So look at this. So the annuity table, 13% 5 years. Page 8A, 13% 5 years. How much is it? 3.517. Correct? So you can just populate the figure here, 3.517. And in case of present value interest factor, you can refer the table, or you can also do it as it is here. So it is 1 divided by 1.13 is equal to, you get how much? 0.5427, approximately it is 0.543. Yes, so 140 into 3.517 plus 1000 into 0.543. If you add the two, you get 1035.40. So that is the current value of the bond, market price of the bond. Are you clear with this? Yes, so very, very simple. In case of bonds, obviously every year the cash flows will be constant. Why? Because this is not like equity shares. Equity shares, any dividend they can pay any year. Fine, there is no fixed dividends for equity shares and all. Whereas in case of bonds and debentures, every year there has to be the same amount of interest. The cash flow is fixed, so always there will be an equal cash flow. Are you clear with this? Yes. So with this, we have finished this particular question, which is question number 7. So let's quickly move to question number 8. Let's quickly move to question number 8. So what is question number 8 given? Very simple. A bond pays 90 rupees interest annually up to perpetuity. What is the value of the bond? Discount rate is given as 10%. Now, sir, what do you mean by this irredeemable bond? Irredeemable debentures possible? Yes, they are possible. Fine. But of course, the interest amount they have given annually, it will be so much. So what is the present value of infinite constant cash flows? Very simple. Annual cash flow divided by the discount rate, or in other words, 90 divided by 0.10. Correct? So 90 divided by 0.10. So what is the present value of this particular bond, irredeemable bond? 90 by 0.10, which is going to be 900. Are you clear with this? That's about it. That's about it. Look at this. Interest amount divided by the discount rate, 90 by 0.1, which is going to be equal to 900 rupees. Are you clear with this? Very, very simple. Very, very simple. Whatever we saw in the time value of money concept, we are just blending along that with, we are blending that into financial management, and we are seeing how securities are getting valued. Are you clear with this? Yes. So with this, I'm concluding this session. So the next, there are a few other questions remaining in this particular segment, which is problem number 9, then problem number 6, and problem number 5. Yes. So these 3 questions alone are left out. This will be done in the next lecture. Fine. So thank you all so much and have a great day.